Good afternoon, everybody, and welcome to the first in this IMAP webinar series on global interest rates and the implication for fixed interest investing. It seemed to me that of all the topics we could focus on in this webinar series, interest rates and both the macroeconomic issues that are impacting interest rates and the impact of interest rates on economic activity and on the markets is perhaps one of the absolutely fundamental issues that anybody who's focused on investing is facing into today. And through this webinar series, we'll be delighted to be joined by some deeply knowledgeable presenters. Today, Cameron McCormack from VanEck, Richard Quin from Bentham Asset Management, and today and tomorrow will be moderated by Robert Moore, who's head of the fixed income team at JANA Investment Advisors. I just want to say a few words before we get going on upcoming events that IMAP is organising through the rest of the year. There really is quite a busy year. So our advice-oriented conference, Advice in Action, will be the 28th of July in Sydney. And we'll be taking a focus on high net worth investing and what it takes to serve that market in a managed account context. Then in September, we'll be taking part in Sydney Alternatives Week with a session called Alternatives in Discretionary Portfolio Management. So as we did last year, we'll be showcasing the role that alternatives play in putting portfolios together through SMA and MDA structures for, again, high net worth and family office type investors. In October, Independent Thought Conference, where we'll have an opportunity to showcase the thinking of asset consultants and portfolio managers on the way they're shaping portfolios at that time. And then a first for us later in the year in November, the MDA Providers Symposium, the 19th and 20th of November. This is a big year for those advisors and portfolio managers for whom MDAs are a key vehicle. The instrument is being rolled over, and we've made a submission to ASIC, and I know others have as well, on what should happen to that instrument. There's no question in my mind, and I've seen from the other submissions, that the instrument should and probably will be rolled over. But the changes that ASIC might implement at this decennial opportunity mean there could be some significant changes in the way MDAs are structured, and the symposium is our opportunity coming a few weeks after the release of the instrument to reflect on what it means for the next 10 years. Of course, this is also the time in which we host the IMAP Managed Account Awards, and we've seen quite a number of entries already. I'd encourage you to participate, showcase your own expertise, the service that you offer as a portfolio manager, as a licensee, as a boutique licensee, in the way you use managed accounts to deliver your service to clients. I'd encourage you to enter that. We encourage questions, and I know from having seen the session today, there will be a lot of opportunity for questions, and there are a lot of issues that you will want to probe on. So now it's my pleasure to hand over to Robert Moore from JANA, who will be our moderator for today and tomorrow. Robert, thanks very much.
Thanks, Toby. Thanks for that introduction. It's certainly an interesting time to be talking about interest rates. We're seeing some movements in bond and front-end cash markets that we haven't seen for a while, and it looks like it's going to continue to be interesting. I recently returned from a global fixed income trip with one of my colleagues, and whilst that was back in March and there's been a lot of water under the bridge, a lot of the learnings from that trip are certainly relevant today. One of the starkest insights from that trip was that almost every single bond manager has been caught offside by some of the movements we've seen in yields. And there was a lot of pain at that stage in a lot of fixed income portfolios. Some of the insights we gained have sort of dated quickly as markets have moved, but equally some haven't. There was almost a universal view back then in March. This was going to be a very transitory event. Every manager was in the range of 2 to 4 weeks for the conflict. Now, clearly, that transitory view proved, very, very incorrect. But equally, they're of the view that the impacts of higher oil were going to be transitory. So, and the markets, to a degree, still agree with that view. We're seeing front end inflation expectations shoot up, but the back ends, 1 year forward, are still, whilst they're elevated, they're still relatively contained. The same with commodity markets. Front end oil has spiked really high, and that's feeding into, initial inflation prints. But the back end oil still, in a year's time, is expected to be, 80 basis points, $80 or lower. And one thematic out of the research group that really still is relevant today is the regional impacts. All of those views of, higher inflation now, weaker inflation later, really are relevant for every region, but how we actually get there could well be different, a different experience. So we look at the US managers still sort of saying it's very unlikely the Fed will hike, although in recent days we've started to see some price in. But on the other side of the coin, we've got countries like Australia where we already had a significant inflation problem. This has only made their job incredibly harder. And the view back in our trip was that the RBA would have to keep hiking rates. And that has certainly played out. And there's probably more inflation through secondary impacts to come. And we could well see more hikes in Australia. So we could certainly see inflation lower in Australia in a year's time, but the reasons why we get there could well be because of possibly, the recession we had to have. So look, with that backdrop, it's a great time to be speaking to some super smart, insightful people about fixed income and rates and what they're doing and seeing in the markets and what they're doing in their portfolios. So our first speaker here is going to be Cameron McCormack from VanEck, and we'll hear from Cameron now.
Thanks, Robert, for the introduction. Just a quick reminder that what I do present today is of general nature and does not constitute personal advice. Next slide, please. Yep. So what I've done here is I've broken down the inflation movements in the US, and then I'll touch on the implications for Australia. So on the left, we have the change in commodity prices, which is the spot index shown by the teal color, and then versus the change in US inflation year on year in the dark blue line. Now, what you can see over the last 12 months is quite a substantial acceleration in commodity prices. So we're seeing gold prices increase, and now we've seen oil prices increase, but we haven't necessarily seen that flow on to headline inflation in the US to the same extent. Now, if we do see higher for longer oil prices, naturally you anticipate US inflation to I guess reflect that. And we have seen that come through in the March print and also in the April print most recently, and that's shown on the right-hand side. You can see that US year-on-year inflation is now at 3.8%, and the key driver of that has been oil prices increasing, just generally energy prices, which is shown in that teal bucket. Now, what we haven't seen yet is the second order effect. So companies passing on high oil prices in terms of goods inflation, having a flow-on effect. And I guess our base case going forward is that we are likely to see inflation potentially increase above 4% in the US and be in a high for longer over the next few years. And if you just flip to the next slide, yeah, so you can see here on the left again year-on-year inflation in the dark blue line versus core inflation in the teal color. Now, consensus is that inflation will just hover above 4%, and then and then revert back to that 2% range, the Fed's target over the next few years. So, Robert talked about, I guess, the market pricing in a transitory sort of effect of oil prices. But from our perspective, we think this is less likely, just given the second order implications of higher oil prices. We're still dependent as a global economy on oil prices. And what we've seen recently is inventory levels be eaten through because of the lack of supply coming out of the Strait of Hormuz. And there is the flow-on effect. As a result of this, we have seen markets reduce. So it was pricing in 2 rate cuts in the US. Now it's 0. And even most recently, as a result of the latest CPI print, we have seen markets start to price in rate hikes starting next year. Now the jury's out as to whether we do see that play out. Next slide, please. Switching gears to Australia. So again, on the left, we have Australian CPI broken up by the headline number, the true mean number, and then also services inflation in the black color. Now, before the conflict played out, Australian inflation was above 3%, the target range, and naturally oil prices are another fuel to the fire per se. If you look at the latest CPI print breakdown, you can see the spike in transport costs because of, again, the increase in oil prices. Now, even despite this, services components, so if you look at, say, education, housing, all above 5%. So clearly there was more persistent pressures playing out in Australia, and the flow-on effect in terms of oil prices could see us even surpass 5% on a year-on-year basis. We have seen rate hikes come through as a result of this. And certainly from our perspective, we think that the RBA will likely keep rates on hold for the next few months, just as it assesses the flow-on implications of the hikes that have come through. Now, one of the key reasons for this is we have seen consumer confidence plummet over the last few months, and that's shown on the right-hand side. This is looking at indicators from Westpac. Both sentiment and current conditions have come off quite substantially now, really at multi-year lows. There's also the implications of obviously the federal budget in terms of implications for investments, and that could be, I guess, more of a less demand because of the changes in CGT and negative gearing. Next slide. So I guess, what's the key takeaway here? Well, because of the spike in higher inflation, both in Australia and the US, we have seen the long end of the curve increase. If you look at the Australian 10-year, it's now at 5.15%, and that's the highest level since 2011. So the market is pricing in a higher for longer environment, and that's certainly our base case for, I guess, going forward. It's hard to see Australian inflation heading back to the 2 to 3% range over the next few years, just given the underlying pressures in terms of unemployment being quite low, and then the second order impact of higher oil prices. If you look at the US, the US 10-year is about 4.5%. And again, the market's really dialed back its rate cut expectations now in a potential hiking cycle playing out next year. The question is whether we do see any potential weakness come through in terms of economic growth. So we've seen a shock in terms of inflation come through, but we haven't necessarily seen changes in economic growth come through. So if we do see potentially a lower growth environment, we think there is a case for the long end of the curve coming off. But at this stage, it's been really first order in terms of, okay, we've seen higher inflation. Naturally, the long end of the curve increase. The jury's out in terms of whether we do see lower growth play out over the next few months. So in terms of credit markets, what's really interesting is that despite the uncertainty here, credit spreads are still at historical lows across most asset classes. We did see credit spreads widen in March, post the uncertainty around how the Strait of Hormuz closure would have a flow-on effect. But because particularly US earnings have been very, very strong, this has supported market confidence in the credit markets, both globally and also in Australia as well. And they're back to really the pre-conflict levels. We saw in, say, Australian subordinate debt spreads increased by 10 to 15 basis points. That's completely reversed. What's also interesting as well is that if you look at the differential between US high yields and US investment grade credit spreads on a differential basis, that's shown on the right-hand side. The differential, again, is at a historical low. So there's not much downside price at the moment. If we do see any potential, particularly weakness from an economic growth perspective, markets are clearly, almost priced to perfection, both in equity markets and credit markets at the moment. And a key driver has been just really strong corporate fundamentals coming through.
Thanks, Cameron. And Robert.
Our next speaker, I think we move straight to Richard, and then we'll have some Q&A times. But I'll hand over to Richard Quin from Bentham to give his perspectives.
Thanks, Rob. Yeah, it's interesting to talk about global rates right now. It's obviously become quite a topical issue with all the moves around the Straits. Maybe if we could go to the next slide. We'll just skip the disclaimer. I think we've been disclaimed. Listen, one of the things that's likely to happen post this shock of oil is we will get a slightly lower growth rate outside the US. The US is in a much different situation than it has been historically because it is a net exporter of oil. If you go back into the 70s, it was not. It was an importer of oil, and it was a much bigger issue. In actual fact, the developed economy is only 1/10 as sensitive to oil prices going forward. But notwithstanding that, the forecasts for lower growth are coming through outside the US, not necessarily inside the US. And so that's something that we think is the next shoe to drop. And again, Robert's comments about this being a very short crisis and then sort of becoming a bigger issue. The oil price will become more sensitive the longer this goes on, and that could be more damaging for growth. And some countries outside in the less developed countries will be suffering because they're more dependent on this source of energy. If you just go forward to the next slide. So just to put it into context, there's been a number of Gulf wars, unfortunately, and oil prices have spiked and done all sorts of things. The most recent war that I think everyone's referencing is the Ukrainian war, and we saw a big spike in oil prices. But at that point, we were just coming out of COVID, and I think we had a much more different situation. So we had very low interest rates at 25 basis points in the US, and we already had a very high inflation rate. Central banks were behind the curve. So I think central banks have done a good job of getting interest rates down to a manageable level. And then, of course, we've got another shock. Now, these supply-side shocks are difficult, and they're also difficult for central banks to manage because they can't impact the energy price. All they can do is see how it's impacting the environment. Usually, central banks will look through an energy spike if they believe it's coming down. Now, the problem with this is how long it will take to come down. But definitely post-COVID in the February 2022, when we had the Ukrainian war, you had inflation already at 7%. You had a cash rate at 0.2%. And we're in a much more different scenario. And also you had a big shortage of labor in the US. So to put it into context, it's not the same as every cycle. Every cycle is slightly different, and the supply-demand sort of setup is different. Now, that doesn't mean that this isn't a very severe issue, and it is a big issue. If you go to the next slide, you can sort of see that Australia's actually been in quite a tight range for inflation, but its current inflation number is high, mainly because I think we've got a positive output gap versus a lot of other countries that have negative output gaps. Basically, that means we've got a reasonably tight labour market. Now, every central bank has a different task to take. And also, if you go back in history, central banks didn't have inflation targets. That was actually something that evolved with New Zealand. And then most central banks around the world have got inflation targets. Back in the 70s, there wasn't that target. So they weren't designed to be as proactive as they are now. But you can see sort of inflation has been in quite a big range in the last few years. What people are worried about now is the inflation expectation, whether that gets knocked in. Now, I think there are two things. If you flick forward one more slide. I think it's really interesting here, and I think it's a much more nuanced situation than most people would think, because we already have interest rates at quite high levels. If central banks hit their targets, you're going to get a 2.5% real return above cash or above inflation if they hit their targets. Now, obviously, it's not that high right now. And will central banks hit their targets is the question everyone's having. And everyone's saying it's going to be longer. And that's probably quite likely that we'll have slightly higher inflation, but we just don't know. And we don't know how much of a shock the oil price. And there's an argument, and I'd probably agree with this argument, that you go to a certain point and the oil price is an inflation issue. And once you go past that certain price, it becomes a demand issue because it actually destroys demand in the economy. And then central banks have to be much more dovish to protect the economy. Now, I think we're not there yet. Oil prices haven't gone as high. So, if we do get a work through on this and we get a reasonable oil price, it's quite possible that oil prices could fall dramatically. We could talk about that as well. But there is some really good value in the market right now. And I do believe that Australia offers good value relative to the US. I think generally we've got the cleanest dirty shirt. Obviously, the recent budget is raising taxes. We have been hiking interest rates. I think we're in a better position than looking at, if you go back to slide 4, the starting point really matters. Back to that's the one. You can see that, we started with much higher inflation and central banks were saying that would be transitory. It's probably the reaction point. They weren't reacting quick enough to inflation post-COVID. Now the issue is, will they overreact to inflation and bring demand destruction as demand is being destroyed by oil prices increasing? And there is an argument that in the mortgage belt, increasing petrol and diesel prices are similar to a number of rate rises. So I think the economy is a little bit more fragile than people think. But if we go forward again to a couple more, this slide basically shows the relative value between the two. I think the rates levels are much higher in Australia, which is good. The inflation level is higher right now, but I think will come down. Fiscal divergence, fiscally, Australia is much cleaner than the US. Monetary stance, like a monetary policy is, I think we have a central bank governor that is going to stick to the plan and try and get inflation down. We've got a good rating. That basically reflects the fiscal conservatism. And then I think there has been an erosion of trust in the US, and I think that's a problem. If you flick forward just on the outlook, so this is where we are. So we're seeing an Australian bond index that gives you a yield north of 5. It's probably a bit higher than that. It's probably closer to 5.20 now. And then we have a cash rate that probably won't reach 5. But we do have a couple of possibly a couple of rate hikes, which could bring us to 5. I don't think we'll get there. But we're already at quite a substantial thing. And if you see relative to cash, and I know people are arguing that, bonds and equities are very correlated right now. I think if you see a decrease in demand because of the higher oil prices, you'll see bonds do a job to protect a portfolio. And if you compare it to COVID, when bonds were yielding 0.63%, a 5% handle's pretty good. So maybe I'll just leave it there.
Thanks, Richard and Cameron. Some great slides in there and some great insights. I might just start with the questions. Cameron, you mentioned secondary impacts there, and the higher cost of transportation is going to feed through to inflation in the future. That seems very much the focus in Australia. So Australian managers, the central bank is worried about those secondary impacts, and then, as Richard mentioned, that could feed into expectations, and if inflation expectations become unhinged, that's a serious problem. And that seems to be the focus in Australia. But for globally, US managers, they're looking all through this and saying it's a tax on growth. Richard mentioned the downgrade there in growth forecast. Why do you think there is that disconnect between Australia's sort of viewpoint and central bank reaction function and the US? Are we paying the price of the sins, and coming out of COVID we didn't raise quickly enough, perhaps?
Yeah, there's a few things at play. So if we reflect on, I guess, where Australia's at, Australia had more of an, challenging inflation backdrop compared to the US. And naturally, the RBA has been, somewhat forced to kick off its tightening cycle. We've seen 3 rate hikes. We're now at 4.35% highest. The previous terminal rate we only had a few years ago. The challenge for the RBA is that you've got more pronounced services inflation compared to, say, the US. I guess there's a range of things at play. So it really does suggest that the RBA is likely to keep rates at least on hold for the next few months as it assesses the flow-on effect in terms of the previous hikes. The market's pricing in another 1 to 2 rate hikes by year end, just given the persistence of inflation. Whereas if you look at the US, they've seen headline inflation increase, but it's been very isolated. I mean, obviously, you'd anticipate goods inflation to increase as well, but I guess services inflation is more contained in the US. So from that standpoint, there isn't as much of a need to really, change to potentially more of a tightening cycle. And I think that's, obviously why, particularly globally, the market's pricing in more of a transitory sort of backdrop in the US compared to, say, Australia. So it'll be interesting to see how it all unfolds, particularly over the next few months.
That's great. Thank you, Cameron. Richard, can I turn it to you? And you did make the comment that we could see inflation stay high for a number of years here. But if I look at Australia's situation, we're going to have a higher cost on a lot of things. That's to feed through in these secondary impacts. We're going to have high rates on mortgages and corporate debt. Potentially got budget impacts on housing, consumer confidence plummeting. It's the glass half empty view, Richard, is that these are the precursors to potentially a recession, and that could well solve the problem there of inflation staying high. It'll automatically self-correct because we could be walking into recession pretty soon. Can I ask Richard what his view there is on the potential for that, and that corrects inflation, but it's in a very painful way?
Yeah, listen, that's quite possible. And again, I think the knock-on effect from fears on AI could lead to people saving more. I think there's a lot of issues that are still standing out. And I think the budget was bad for confidence, not positive for confidence. So I think there are some real issues. Also, I think Australia, we were more affected by this oil price increase than we were by the Ukraine. Like, because we're dependent on refineries offshore, we had to go begging. I probably no one wants to hear that, but it's true. And we're a net exporter of energy, but gas, we import a lot of our refined goods. And so that's been bad. And that's hurt the average tradie. Like, diesel prices were up 65%. Really did have an impact. And they've come down a bit. And in actual fact, I think the next inflation number you'll see a lower energy input into that. So probably a negative to inflation. So it could bring inflation down a little bit. So it's going to be nuanced as we go through this. Listen, the confidence numbers are at levels that are equal to recessionary levels. I think they've just knocked it again. But again, we just have to see how it transitions through this. If oil remains tight, like Australia will get oil. We'll overpay for it and we'll have oil. We'll have refined product. We'll just overpay for it. But developed countries will not have it. They will start curtailing demand. So that's going to knock on elsewhere. So there's definitely a lot to play for right now. And I'd like to say that I'm fully confident that I believe there's one more rate hike and then it's a great time for bonds. But that's a belief. That's not. No one has certainty in this.
No, great answer. Can I just quickly stay with you though, because you touched an interesting point. Australian yields certainly do, from a nominal and a real yield perspective, look attractive, but the difficulty is we're still highly correlated with US and global bond movements. Do you think that time will pass and there's going to be greater divergences in the globe, US, Australia, Europe, somewhere in the middle?
But listen, whenever the US has gone into a harsh recession, we haven't gone into a harsh recession. Whenever we've gone into a harsh recession, the US hasn't gone into a harsh recession. I think we've got to remember China hasn't been doing that well. China was exporting a lot of deflation. In fact, it's not doing it right now. And then I think there is a lot of transition around this. Could we see a bust in AI, or could we see an increase? So if we see an increase in productivity, growth can go higher in Australia. Okay. If we don't, the RBA's got a real problem. And I think the RBA, for the first time, I've seen them lean against government on their fiscal issues. And I do think those two things interplay. But yeah, it's definitely possible. But the thing is, I think fixed interest can sometimes perform that balancing act. And I think, Cameron's comments that riskier credit looks risky. I look around the world and I look at assets right now and I go, risky assets look expensive. I look at fixed interest. It doesn't look that expensive to me. It looks actually quite reasonable. And should you see a bad environment, I honestly believe that fixed interest will do quite well to help protect people's portfolio. But I would go back to that thing to remind people that back in COVID, you would have killed for a 5% yielding asset that's government guaranteed. I don't think that's a bad thing. I do think there'll be opportunities in credit as they come through. And probably something we should have touched on was BDCs and private credit have had a really bad first half of the year. Well, not quite first half of the year, but I think it's probably going to continue. And that's around software disruption and that creative disruption that we're seeing in markets.
It's a great point, but I don't want you to steal our thunder from tomorrow's session. So,
Go.
But having said that, we can talk about investment grade, and maybe that's the middle ground here. We're getting the duration protection, Richard, that you mentioned, but Cameron, your slide noted that despite all that we're talking about, all that's going on in the world is getting worse, not better. This conflict is getting longer and more intense. Oil's going higher, rates are going higher, It's not great for company earnings. Yet IG spreads are making new lows almost. What on earth is going on in investment grade spreads? Is it a safe place to sit, or is it getting too expensive?
Yeah, it's an interesting question. So if we reflect on really the last 2 months, we've seen US reporting or US Q1 results come out, and they've generally been very, very strong. So in terms of the S&P 500, new net beats are like 81%. That's above its 10-year historical average. Now, because US corporate, I guess, balance sheets have been very strong, that's had a positive flow-on effect for all US corporates, but also Australian corporates. And we've naturally seen credit spreads across the board, essentially effectively go back to their pre-conflict levels. And I think, if you look at credit spreads across the board, yes, they are, I guess, tighter than the historical average, but I think, it's a fair assessment in terms of where corporate strength is coming from at the moment. And I guess the key challenge, if you think about, say, Australia versus the US, Australia, in terms of credit spreads, are tighter, but they're not necessarily the historical tights that they have been. Whereas if you look at, say, the US, they've tightened a lot more. So I think, potentially from that perspective, Australia potentially is offering more, I guess, relative value from a credit standpoint.
Cameron, did you want to make just one quick comment though? Like a big part of the issuance in investment grade has been enormous issuance from the hyperscalers who seem to be spending like a drunken sailor, and they haven't got the revenue models yet to back it up, but it's just continuously being lapped up. Is this an investment opportunity because of all of this issuance? Is it a risk for investors? How do we think about it?
Yeah, so I think there's two sides to the coin. So we obviously know there's been a lot of investment in AI CapEx, and we have actually started to see that flow on in terms of high earnings growth. And if you think about, I guess, the hyperscalers, they're the mega names, and they've shown, I guess, a strong track record in, obviously, from where they've been able to grow their business. So I think that's, I guess, a positive to reflect on. But having said that, if you look at, I guess, CapEx relative to revenue, to earnings, and even just cash flow, because of that, I guess, deterioration, we have seen credit spreads widen in those pockets. But overall, if you look at US corporates, they've been quite resilient.
Very good, thanks, Cameron. Richard, can I throw one to you? In amongst all of this tightening environment in Australia, we've had the budget, and there's been a somewhat of a watershed moment in terms of the housing policy and trying to make that a less attractive sector. Is that a risk that housing is shifted, the psyche around housing shifts right at the wrong time, that we're in a slowing growth and we could really tip over here and confidence can plummet and economic activity could grind to a halt? How did you see budget on housing, Richard, affecting the outlook for the economy and rates?
Yeah, listen, to be honest, housing hasn't been taken apart in Australia for a while. It's had all sorts of lingering things. I think part of the shortage of housing in Australia is people working from home. I think it's decreased the density of housing in Australia. There was a need for reform. I think this is going to have a knock-on effect on investors. And if you buy a new property and you don't, you can't sell that new property on, that becomes an old property, right? So I'm not sure how the profitability works for people in this market. We've already had 3 rate hikes. We have another rate hike. I think people are already hurting. The other tax effect from the increase in energy prices is equivalent to a number of rate hikes in the outer suburbs. And that's actually, that's why I think confidence is down, because their disposable income's down. To date, everyone's kept up their consumption. And in the US, it's because of tax cuts. In Australia, it's probably because of tax cuts too. If the government can do something about NDIS, which has been a huge stimulus for the economy, they can tighten this economy up. If they're going to do a tough budget, this should be the tough budget. I think it could have been tougher. I think the Reserve Bank, if it's tough enough, they won't hike, but they probably still need to hike. And then what happens with oil is going to be the thing that plays out. It's like that random element. I just know that every time, President Trump says the Strait's open, looks pretty close to me. But I think post this, we'll see a lot of investment in oil and pipelines and the like. And so, that's the thing that sort of annoys me right now. We're seeing this huge spend in AI, huge spend in defense, and now a huge spend in oil infrastructure. These are capital drains. So maybe, credit spreads could go up. Like if you see the response from this oil price that I think you could see, and an increase in production, and Venezuela has not been productive, let's say, because it didn't have access to those oil service people. You could see a lot of oil come online, and that could lead to a much lower oil price. And also, OPEC's been a bit knocked around a little bit recently, so they're going to be a bit more roguish in throwing it out. It's great if you're in the US and you produce oil, you're making super profits right now. But I think there's a lot to play for right now. I'm not going to say recession, because like recession's of a very rare event in Australia. We've got that shock absorber of the Aussie dollar. Obviously, we're getting a lot, and this budget would have been a lot worse without the energy prices going up, ironically, because gas.
That is a great point, Rich. I mean, you made a lot of great points just there. That was fantastic. Thank you. But that natural shock absorber in a commodity-led environment, and one where the RBA is going to raise rates to a level, or is mostly done to a level that's materially different, do we lose that shock absorber? Could the Aussie go to 75, 80 cents and that's just going to kill us?
The Aussie going to 75, 80 cents would have a negative impact on inflation because we import a lot of stuff. So I don't think that. I think that'd be great. I'd be happy. Like my thing is, I think there's you're getting some value in fixed interest now, relative value in fixed interest, which we haven't seen for years, right? So relative to equities, and equities, I know they've had a good quarter. Good luck. I think the next half of the year is going to be more difficult for most. And in the high yield space, we have seen a lot of these hyperscaler facilities. We haven't invested in one yet in the high yield space. Now, maybe in the investment grade space, it's a different world. But in the high yield space, a lot of it is, if you don't complete on time, they've got the right to, just say no thanks. So I think a lot of people are overbuilding capacity. And that we've seen it before, like in 2000, the internet, we had a lot of, and ironically, some companies that were doing really poorly during the 2000s in the internet are actually making a lot of money now because they're connecting up these data sites. So I don't know. There's a little bit to play with. I wish I could be more certain, Rob, and but that actually means to me that credit spreads should be wider because there's some volatility. And then, interest rates have really moved a lot. Like, could they move another level? Inflation expectations, which we haven't really touched on as much, like I think that's the key. And our inflation expectations, our measure looks pretty sloppy relative to the US. The US looks more contained. I think, maybe our government's not leaning on inflation as well as they could. The NDIS thing, I think, was a good thing, though. But also cutting that back is going to be so hard.
Yeah, great points. Cameron, I think we've got a couple of minutes left. Can I just turn to you to what should investors be watching to think that maybe the worst is behind us and the bad man goes away? Are we looking at front month oil? Are we looking at back month? Do we need to become crack spread experts in diesel? Are we looking at inflation prints? Shipping? Richard mentioned shipping rates. What are you watching for signs that the worst is behind us?
Yeah, so one of the key, metrics outside of, economic indicators is the oil futures curve. So I guess in the onset of the conflict was in quite steep backwardation. So what that means is that essentially oil prices currently high, but expected to taper off. What we have seen is a flattening in that curve. So what that's suggesting is, oil is likely to remain, high for longer. So I think certainly how the market's pricing in future oil prices is a key barometer, because that will is a suggestion for where inflation expectations will land, and then also, I guess, the second order is growth expectations as well. But I think other things to watch is corporate earnings. US earnings have been quite strong. That's been positive for not only equity market confidence but also bond markets. And I think if you look at all-in yields in Australia and in the US as well, Richard talked about this quite a lot. With yields at 6% for corporate. If you look at the long end of the curve in Australia, it's a lot more compelling than where it was even a few months ago, and even relative to 15 years ago. So there's a lot of I guess opportunities to think about.
Great, fantastic. Toby, can I just check our timing here? How much longer?
Yes, look, thanks very much, Robert, Cameron, and Richard. That's been fascinating. It's I must say you do seem more sanguine than all three of you than I felt coming into this session. So look, for those of you who've joined us today, I hope you've found Richard and Cameron's views on the things that are driving interest rates relevant and insightful, as I have. And I hope they have set the context for the next two sessions that we have. Robert will be joining us again tomorrow. We'll be looking at the impact of rates and these markets on the opportunities that are outside sort of mainstream govies and investment grade corporate areas. We'll be looking at private credit and infrastructure debt and the opportunities that those two sectors of the fixed income market give rise to. And then on Wednesday, we'll be joined by Jonathan Ramsey from Trelia and Cameron Harrison, who'll be talking about their feelings as portfolio managers about how they interpret these geopolitical and interest rate trends in the way they think about constructing multi-asset class portfolios. So thanks very much for joining us. We'll look forward to Robert returning tomorrow. Richard and Cameron, thank you very much for your input. The slides, which are, as Richard said, action-packed, are available to you. The session will be available to you all on IMAP Connect, and today's session is CPD accredited. So thank you very much, Robert. We'll look forward to you joining us tomorrow with Frank Danielli from MA Financial and Australian Ethical. So thank you very much, and we'll look forward to you joining us again tomorrow. Thanks.
Thanks, Toby.
Yeah.
All right.